In Chapter 9, when it covers all three of those different business income deductions and accounting methods really stretches into a little bit more advanced material. It doesn't mean that it doesn't have to be or need to be covered. It just pushes the level of what information needs to be discussed. And it's just a little bit advanced. One of the things the author actually talks about in there is whether or not this is considered the first level of accounting or the second, so it's in the book. I think I asked one homework question about accounting methods or accounting methods. I did that to see, it's a very basic question about it, but I won't ask about it on your exam. All right, so I want you to know just enough about it, but it's nothing that you need to memorize or nothing that you need to flag when you're doing your homework that you need to know this for the final or for the midterm, okay? Same with quiz questions. Even if you see a quiz question, I would not pull a question in for multiple choice onto the midterm. All right. So you just need to know a very basic amount of it. What you're seeing on the board is a Schedule C. Now you should have a Schedule C, I believe. I've already given one to you, and I've actually put one on Blackboard under the documents. So the Schedule C, when we've talked about it, there's several different components of a Schedule C. Tonight we're just going to talk about it at a high level again, but we're going to talk about what goes on the gross receipts. I say gross receipts are the income that's coming in. A lot of times what you're going to see on most Schedule Cs that you're looking at is you're just going to see line 1, and then line 3 is going to be the same thing, line 5, and line 7. And the reason behind that is line 2 is returns and allowances. So your gross income is only going to be affected if you have returns. And then line 4 is cost of goods sold. So line 5 is only going to be affected if you have cost of goods sold. So when you're looking at an individual tax return and you're doing a Schedule C, you're only going to have those two things for cost of goods sold if you're actually selling an item. So think about the different types of small businesses that would be doing a Schedule C at home. Those would be the ones that would have a cost of goods sold, something that's carrying an inventory. And we're going to talk about inventory tonight too. So a lot of the small businesses that you know of don't necessarily have a cost of goods sold, don't necessarily have that inventory. They're just a revenue stream, all right? But if you have an inventory, you'll have that cost of goods sold, which will come down to gross income. Then everything in Part 2 is your expenses. We're going to focus tonight on what is considered a reasonable expense. Then 28 is your total expenses, leading down to line 29, which is our tentative, I blow that up, that's our tentative profit. Right. Then they have something called expenses for business use of your home, and then you have to attach something called an 8829, which talks about how you're using your home for business purposes. Now this is different than when you're deducting your home more for an itemized deduction, all right, for non-reimbursed business expense. A non-reimbursed business expense goes on your itemized deductions, and you're looking at taking a X amount of square footage. Here, this is going to be when you actually have your business and you're doing a Schedule C. So that expense is going to be on line 30. Then you get your net profit or loss. And remember what I said on the back side is our cost of goods sold if you have it. It's going to go into details not only about inventory, the different types of methods, which is in this chapter, cost of labor, materials, inventory at the end of the year, which gives us our cost of goods sold. This is pretty in-depth. And just because you have a cost of goods sold does not mean you have materials and suppliers, does not mean you have cost of labor, does not mean you have all these lines. You could literally have cost of goods sold and it could be a supply of, I'm trying to think of something you would say, jewelry, right? So if you're a jewelry supplier, that could be your cost. If you are buying the jewelry up front and turning around and selling it. I have a lot of friends that sell a product called Advocare, which is a healthcare supplement, I guess was how you'd call it. Now, for the most part, you order that yourself. Okay, they get the money by you ordering it. But they also carry an inventory, and then they can sell it directly or give it out as samples. That could also go here, but wouldn't have the cost of labor or anything else. Then here's where you put your car. You got your business miles, commuting miles, which we're going to talk about if you used it for business purposes. And then part 5 flips back over to the other page, and it's where you have what's something called other expenses. So if we flip back over to page 8 through 26, and then what sums up on line 30, some of these other expenses, line 27 here, A, if you have something that you just don't know where it goes, that's what you list out on the back, and you list it out in detail. All right, so that's where you put it. All right, so let's go to the slides now. Let's see if I can get this to flip correctly, because it loves me so much normally. Wait a minute. There we go. All right. So some of the things we're going to talk about, like I said, we're not going to go into the detail of the accounting methods, just the general business deductions, talk about some of the business, special business tax laws, a little bit about the accounting periods, and we're not going to really get into the methods. So a Schedule C is about trade or business. Like we talked about on that form, it involves revenue from services or sale activity. The difference between services and sale is a service is offering something that you're providing, and a sale is selling a good. All right. The gross profits, cost of goods sold. Business income does not include any type of deferred income, which we'll talk a little bit about. And then the key here under the last bullet point is that deductions have to be directly connected to the business activity. This is where some people that do their own taxes get a little confused. Right? Business deductions have to directly connect to the business activity. Ordinary and necessary means that they are conducive to a profit generation. What are you doing that's costing you money that should be helping to generate you profit? Right? And then also, is it a reasonable amount? And that's what we're going to talk about here, because that's something that's very important. So for example, Rick owns a business that employs his brother Ben. He pays Ben $45,000 a year. In comparison, other employees with Ben's responsibilities only make $30,000 a year. So he's paying his brother $45,000, but in other jobs just like that, people are making $30,000. So what is Rick's business deduction for employing Ben? Can he deduct $45,000 in salary because that's what he's paying, or does he have to adjust how much he's deducting? He does have to adjust. So what he has to do is what's called a reasonable solution. So the reasonable amount for Ben's salary is $30,000. If everybody else that does Ben's job, when I say everybody, a reasonable amount of people, are making $30,000, then what they're saying is Ben's being paid $45,000 because he works for his brother. Right? So therefore, when you're looking at it, he can only deduct $30,000, and the extra $15,000 is considered a gift. Now you got to be kind of careful, because while Ben, the $15,000 doesn't matter that it's a gift, Rick can only give how much as a gift every year? $14,000. Isn't it 500? I think it's $14,500 per person from each person. So he just went over the gift amount. So he'll have to pay gift tax on the extra $500. So he is working for Rick. Rick is an individual sole proprietor, so it is considered non-reasonable or not reasonable that he is paying his brother, which is also an issue. That's why it's also not considered reasonable, $15,000 more than everybody else. Now, if this was a regular business, my brother works for a company. My brother makes, I'm making these numbers up, but my brother makes $30,000 more than any other sales rep in this area doing almost the same thing. That doesn't necessarily mean his company cannot deduct his salary, because that isn't the same thing as a Schedule C person who is working for his brother. I also don't think you'll find that same thing in a company where they're doing the exact same job where someone's making $15,000 more. There's a lot more comparison. The thing here is it's a Schedule C, somebody working for his brother doing similar jobs. And you do tend to find people being paid different amounts. So what they're trying to do is make sure you're not, I'll give you an example. I'm not saying I know this for a fact. I'm just saying, hypothetically saying, you have your own business and you file a Schedule C. You're not making a lot of money. You're making 15 or, I know this sounds bad when I say this, for somebody with 3 kids, you're not making a lot of money, okay? You're making an extra $15,000 a year. But your thought is that your kids are now getting older, so you could technically pay them to work for the Schedule C company and then write off their salaries. Now, is that legal? As long as they're old enough to work. Yes, that's legal if they're working. Okay, they actually have to be working. All right, so assuming they're actually working, that's legal. But if the normal 14, 16, 18, however old the kids are, year old salary is roughly minimum wage to $10, which is going to be the salary, and you're paying your kid $15 an hour, is that not going to be a little strange that you're deducting $15 an hour to a 16-year-old to help bring down your taxable income? That's why this reasonable test exists, to make sure that people that can manipulate salaries are not manipulating them to what we might almost want to call arm's length transactions, but for a different purpose, to people that they know to help them, to help the person, right, and also bring down their taxes. Right. So that's what this is. So that ends up being a gift. All right, so expenses, when we deduct them, first of all, you cannot deduct anything that's against public policy. Meaning, if it's a bribe, you cannot deduct it. If you're paying a fine, you cannot deduct it. And you cannot deduct political contributions. A lot of people don't get that one. Right? A political contribution is not a charitable contribution for a business or personal. A lot of times when you do taxes, people bring in political contributions and think they can deduct them. That's a political contribution, not a charitable contribution. They're not even close to the same thing. All right, though there are some people that think they are very similar to the same thing. Right, anything against public policy is not an expense. Expenses related to tax-exempt income. You cannot deduct interest on a loan where the proceeds are used to invest in a municipal loan, and you can any what they call key man life insurance premiums. When you have life insurance on somebody where the key beneficiary, where the beneficiary is the business. So if someone is really important to the company and you take out a life insurance policy and the business is the one who gets the proceeds, you cannot deduct that as an expense. However, if you take out life insurance on your employees where their people, their own family are the beneficiary, then you can deduct that as a business expense. But you can't deduct a business expense where you're the person who profits. And then you cannot deduct capital expenditures, and you cannot deduct personal expenditures. It's not going. Hit the wrong button. All right, so the question that you have to ask yourself about capital expenditures. Now, not everybody has to take financial accounting, so just real quick, a capital expenditure is something that's going to provide you a future economic benefit. So the question you have to ask yourself is that future economic benefit going to be greater than a year? If it's going to be greater than a year, then you're going to capitalize it and spread it over a period of time. You got to determine how long that benefit's going to last you. If it's going to be less than a year, you're going to expense it. So, for example, if I have a rental house and I go in and paint it, well, there's different rules there, so that's not going to be a good example. If I go in and do a whole bunch of maintenance, I do cleaning, I do landscaping, I put a lot of mulch down, is that going to be something I capitalize or I expense? Expense. But if I go in and put a new air conditioner in, I would capitalize. I would hope that's going to last more than 12 months. All right. Now the 12-month rule for prepaid expenses. If it's a benefit for less than 12 months and they do not extend beyond the next tax year. So if it's like November and I prepaid 18 months for 2 years worth of insurance, I could not take it all as an expense right now because it's actually going to span 3 tax years. You can't do that. It would, because it's November, it would be this tax year, it'd be all of next tax year, and it would span into the following because it was 2 years. So you can take it if it only is this year and into next year as an expense. And then it does not apply to interest. You got a question?
I have a question, yeah. So on the next cases, we gonna take the amount and consider it as expense.
That's an expense.
Yeah.
Yeah.
For the capital expenditure, when we gonna get the air conditioner?
We're going to spread it over the life of what we believe it's going to last. So for an air
So
conditioner,
assets,
that would be, well, yes, it's going to be depreciated or carried over as an expense and spread over 10 years normally, because an air conditioner is roughly a 10-year asset, depending on the size of the air conditioner.
So it's gonna go to the balance sheet, not to the income statement. As
Well, in that example, no. You're looking at this only for tax purposes. We're not looking at the financial statements, okay? So we're going to take that asset, and if we spent $10,000 on an air conditioner, we're going to divide that by 10, and we're going to spread the life of that over 10 years, okay? So we're not talking about depreciation expense. We're talking about how we're going to spread the expenditure, the fact that we spent money on that asset, okay? Because this isn't, right now, we are depreciating it, okay? But this isn't a company that has depreciation. Like as a whole, a Schedule C company isn't depreciating day to day like a big business would. They only depreciate it when it comes to taxes because most Schedule C companies don't have a balance sheet. They don't have an income statement. They don't have a statement of cash flows. They don't have a statement of retained earnings. The only thing they do is this at the end of the year. So this is where they do the depreciation. They calculate it one time a year, and they do it on their taxes. And you need to be very careful because if you do depreciate, you need to know what you did last year to make sure you continue it. If you switch tax preparers, you need to make sure you have your prior year's taxes. If you switch tax programs, you need to make sure you can do it. It's one of the reasons in VITA we do not do depreciation because we do not necessarily know the people from year to year. We get new people. We do not keep the software from year to year. We clear off the system so that we don't have any personal data on the school computers. So someone comes in from last year and we did a Schedule C with depreciation, we don't have what we did last year. So we'd be relying on them to bring us that information, and as Zaid knows, that's not reliable. They don't bring back what they're supposed to bring back. They don't even bring what they're supposed to bring to start with. Exactly. I mean, there are some very standard documents that you need to bring to have your taxes done, like a W-2, all right? And now they need to have a picture ID. Those two things are pretty standard, and we have some people that can't bring those. So, you know, when you're telling them now they got to bring their depreciation with their statements, a standard thing too is you bring last year's taxes. Just bring them in the envelope from last year. It's very difficult for a lot of people, so we just don't do it. All right, so here's an example of Ben, same Ben. All right, Ben is a cash tax base. Okay, now we'll talk about why in a minute. He makes the following payments on June 30th. He makes $10,000 for the next 10 months of utilities, $12,000 for insurance over the next 24 months, and $9,600 of interest for the next 8 months. What can he deduct this year? So what can he deduct, if anything, of the $10,000? It's $10,000 of utilities. Okay, so to $6,000. Now, what did we say we could do with expenses if they were deductible in the next year? We said they could take all of it, right? So he can take all of the $10,000 in this year, as long as they were deductible in the next calendar year. What about the $12,000 for insurance? Is that going to be deductible in this year and the next calendar year? No,
It's 24 months, he's gonna hit a
because it's
third year.
24 months. So this is where it gets complicated. Now, we don't just get to take what could be in a year or a year and a half. Now we only get to take 6 months. We only get to take what's actually in this year. So we lose the deductibility of the next year as well. We just get this year. So it's 24 months of $12,000. That is $3,000 every 6 months. So we get to deduct $3,000 because we spanned into 2 calendar years. And what about the $9,600 for interest? It was 8 months of interest on a business loan. What was that last bullet point of interest?
Does not apply.
Does not apply. It does not apply. So the $10,000 was all deductible because the benefit ended before the next year. We only could do $3,000 because it went over more than the 2 calendar years. And Ben can deduct only $12,000 because the 12-month rule applied. So we had to figure out of that 98, I think it was $100 of interest, how much of it was in that year, and that's all we could deduct. You can still deduct interest, but you can only deduct what happened in that year. Now there are a few special business deductions, losses on the disposal of business assets. So when you recognize the loss, it's deductible, meaning when the loss happens, it's deductible. Casualty losses are limited to the lesser of either the actual decline in repair or the basis. Does anybody know remember what we said the basis was? I said decline in repair. Decline in value or repair cost or the basis. What did we say the basis was?
That's what you paid for it, isn't it?
It's what we paid for it or any adjustments that got made because of improvements that happened or decline in value. So if we bought it for $10,000 but we added significant amount to make it 12, the basis might be $12,000. That would be called the adjusted basis. So if the decline in value, our basis was $14,000 and now a casualty loss made it only worth 10, then the value could be 10, so we'd have a loss of $4,000. But if the basis was much lower, maybe we wouldn't have that. And then the basis is the amount of loss if it's completely destroyed. So if something was completely destroyed, then your loss is going to be the basis, whatever your basis was. So if our basis was that $14,000, it was completely destroyed, our loss would be $14,000. All right. This is one of my least favorite things to talk about. All right, this domestic production activities. This is a deduction that was... I used to say this wasn't this big a deal because it didn't happen, and then I had friends that actually do it, so it kind of made me say, oh, I guess I don't know what's really going on. It's a deduction that came about to encourage the production of items inside the United States. Hence, domestic production activities, right? Make things here. Make things, whether it's small things, make things here in the U.S., make things domestically. So it's an artificial deduction. It's a made-up deduction that subsidizes domestic manufacturing. So qualifies for a subsidiary. I never say that word right. Subsidy, but income has to be allocated between what's called a qualifying and a non-qualifying activity. So not all activities qualify for this. It's 9%. The subsidiary is 9% of either the lesser of the qualified production or the modified AGI. All right, now remember we talked about modified AGI already. So it's going to depend. It's the lesser of the two. So the formula is what's called the QPAI. One of the things I don't like is there's too many 4-letter abbreviations. It's the DPAD and the QPAI. So the domestic product gross receipts less those that are attributed to the production. And then the deduction is ultimately limited to 50% of wages. So you can never take a deduction that's more than 50% of the wages that you spent in the production of that item. So, for example, Ben recorded $100,000 receipts in the production of this activity. Whatever it was, he had $100,000 of receipts. So he made a lot. He allocated $55,000 of expenses to that $100,000. And of that, $12,000 were wages. Okay. His AGI was $47,000. So the first thing is, if you take the $100,000 and subtract his expenses, he had a, quote, profit of $45,000. His wages were $12,000, so regardless, we cannot exceed more than $6,000 of a $6,000 of a subsidy. I keep saying subsidiary. $6,000 of a subsidy. So we have $45,000 of profit, modified AGI of $47,000. We cannot exceed what we said was $12,000 or $6,000 total. So then we're going to look at taking that $45,000 and we're going to multiply it times 9%, because that's our QPAI, and that's going to give us our DPAD, which is our domestic product deduction, which is $4,050, which means that's what we can deduct. It did not go above 50% wages. The $47,000, remember, the QPAI cannot exceed his AGI. QPAI was only $45,000. His modified adjusted gross income is only $47,000. So the way this could have changed is if his expenses were only $40,000, his qualifying income would have been $60,000. If his qualifying income was $60,000, he would have been limited to $47,000. And then this number here, instead of $45,000, would have been $47,000. So he would have been limited on that. So he would not have been able to go over that $47,000, or in that case, that $6,000 number. So that domestic deduction actually goes online. If you look at your 1040, I got to find mine because I did not have it out in time. There's actually it's actually on Schedule C. Take that back. There's a line for that. No, I can't find it. And you'll be able to put that deduction on there. And now I'm not finding it. I think it's actually, I just said Schedule C. It must go on. Why can't I find it? Well, now I'm not finding it, as I point out. And I cannot. I must have given my last 1040 to somebody. And I didn't print another one. I'll look it up. And you got it? Yeah. Line 35 on your 1040. Is that what it's on? Okay. So that doesn't actually hit your profit and loss. It actually goes directly on your 1040. All right, so now what about business expenses with a personal benefit? So there's no deduction for any personal expense at all. If it's purely personal, it just doesn't go on your business expense. Now, when you have the mixed motive is when it's kind of hard. So what about a business trip that's primarily business, but you have a little personal in it? Or otherwise, what do you do when it's kind of 50-50? You allocate the business to personal. You go and you try to figure it out. So a business trip that's primarily business is a business trip. A business trip where it's kind of a little bit between business and personal, then you got to allocate it. And the most important thing is you got to keep good records. You got to be able to go back and show what you did on the trip. So look at this example. Ben paid the following to attend a meeting in Chicago: $1,200 airfare, 3 nights in a hotel at $750, so $250 a night, and 3 days of meals at $270, which is $90 a day. What amount are deductible if Ben spent 2 days in the meeting? So therefore, if he's spending 2 days, that means that it's primarily business. 2 out of 3 is primary business. So if he's spending 2 days in the meeting, how much of the airfare is deductible? $1,200. Okay, he's going to be able to take all of it. Wow, that's a big, thick marker. He's going to be able to take all of it. That's where too. Okay, and then what about if the hotel? If it's 2 days out of 3, but it's still primarily for business, can he take all of it? Yes, he can take all of it. All right. And then what about the food? What can he do with the food? 50%. What about, does it matter if he had personal business at all with food? Could he ever deduct $270 in food? No. Okay. Food is always 50%. The only time that you can deduct the full price of a meal is when it's considered entertainment of a client. And you do need to be very careful of that one, all right? They've gotten a lot stricter with entertainment of a client, so you need to be very careful about that one. So if you were primarily for business, you got $1,200, $750, and then actually what I wrote on this, it should be 180. So you have 3 nights and you get half of it, 180. All right, but what about if Ben spent only one night? One night for business, the rest of it was pleasure. Can he deduct the airfare? He still went on a business trip, but one night.
He allocates, he's gonna deduct a third of it?
Okay.
Or you have to deduct
Honestly, that would be a rational decision. But the way that IRS looks at it is, if you're going out of town for 2 nights of personal and 1 night of business, that's not a business trip. So you get no airfare. You get no airfare. Now, what about a hotel? 1 night of business, 2 nights of personal. Do you get the night of business there? There you get there you get 1 night of hotel. So you do actually get 1 night of a hotel because you were there for business, you got the hotel. The reason you don't get the airfare is you are spending whatever amount of money to fly somewhere where the primary benefit is personal. So the airfare wasn't for the business trip. The airfare was for a personal trip in which you tagged on business. So that's why you don't get it. So, but if you're there already and it's business, then you can get your 1 night of hotel covered. What about the meals? We already know it's 50%, right? But how much do they get then for their food? $45. And actually, I was making notes on here, and I wrote 180 on the last screen. I should have wrote 90. So that is correct. So when we go and look at here, then there's our summary. So 1,200, 590, 0, 250, 50, 45. And you just got to remember that it's always, and I wasn't thinking, I was thinking they gave us the 50% at first. You always get 50% of meals. Always, always. So what we have to figure out what we learned to identify is what's considered gross income and what's considered deductible expenses and what's not. And then we need to match those deductions to specific periods. When do we have that? So let's take a look at a problem.